Good morning, everybody. Welcome in. My name is Ryan Huston. Obviously, I am the Western North Carolina market lead for Savvy STR agents. We work exclusively with short term rental investors, helping buyers find the right properties in the right markets and get them to the closing table. Today's topic is one that's really important for our investors, and that's really about lending. Investors come to us all the time who found great properties. They know the numbers work, but they don't get the loan from the bank because they're told they don't qualify, whether that's going to be for personal income not being high enough, or you're self employed, or you already own what they consider too many properties. That's the problem we're going to solve today. So we've got two excellent individuals. We have Matt and Rand here from STR Home Loans who are going to walk us through DSCR loans and investment lending. Realistically speaking, what we're going to take away from today is what the DSCR loan is, how that math works, whether or not you'd qualify, even if the conventional lender said no, and exactly what to do next if this is your situation. So, while you're here, if you don't mind, drop some comments down. Let us know the state that you're in. Say hello so we know who is here. But Matt and Rand, I'll let you guys kind of introduce yourself and lead us through.
Sure, yeah. I'm Matthew Placito, so been with STR Home Loans a bit now. Been in the lending world for going on a decade, which is crazy. Spent a lot of time the last 8 or 9 years with two of the top five home builders in the country, doing some more standard financing, and then dove right into short-term rental and STR financing exclusively with STR Home Loans. So we're really excited to be here today. Really excited to talk through some of this and help out in any way we can.
Yeah, and I'm
Awesome.
Rand. So I have experience in the DSCR space specifically. Before actually coming over to STR Home Loans, I actually worked for a rental specific lender that did all we did was DSCR loans. So yeah, happy to chat with you guys going forward.
Awesome. So, looking at the DSCR loans and SGR investors, obviously, first, if you're self employed, your taxable income on paper is probably lower than what you actually earn. And of course, most traditional lenders are basing that on that tax return, but that's not the real number. Secondly, if you already own investment properties, those payments count against your debt to income ratio. And at some point, conventional lenders just say that you're maxed out, even if every property you own is cash flowing and you are able to support that next investment property. And then, third, really the big one is that most conventional loans will not count the STR income
Hmm.
the same way they count long term rental income. So, a property that earns 4,500 a month on Airbnb might get zero credit from a conventional underwriter because there's no 12-month lease to verify. So Matt and Rand, where you sit, how often do you see those investors come to you after hitting that wall? Is that a typical conversation you're having on a regular basis?
Yeah, it's pretty standard, Ryan. You hit on it, but traditional lenders are going to normally use what's called a 1007 on an appraisal, which is a long-term rental comp. Obviously, that long-term rental comp is not nearly what it will perform as a short-term rental, and that income. So traditional lenders that don't specialize in this field will not be able to use the sources that we use, like AirDNA, for that short-term rental income. And then they're going to tell you that, hey, we don't qualify, or your debt to income ratio is too high. Where that is the benefit of the DSCR loan is we don't care about that. It doesn't matter what your income is. It doesn't matter your W-2s or your pay stubs. What really matters is the property. And when you use a lender and a broker like us, we specialize in short-term rentals, so we can use things like AirDNA to calculate that DSCR ratio and use just the property to qualify. So we see that all the time where conventional just isn't going to work. To your point, you mentioned earlier, you're self-employed. You may make $500,000 a year, but on those tax returns, it doesn't show that number. And that's where that debt to income ratio can come into play. And that's why the DSCR is such a huge product for us to use, because we're only using the property. We're not using anything personal.
Yeah, that makes a lot of sense. And that's a huge benefit as well.
Hmm.
Yeah. Okay, awesome. And then Rand, for you, any kind of nuance in your perspective from kind of a day-to-day operation with these conversations?
Yeah, absolutely. So specifically, like Matt was talking about with the DSCR loans, a lot of lenders will tell you they can do short-term rentals because they technically can, but then they do end up ordering a 1007 report, and that's where your rents are going to be qualified. So the issue with that is you're into the loan now. You've been in the process for a couple weeks. The appraisal comes back, the 1007 comes back, and it's drastically lower than what you expected this property to make. So that then now you're having to find another lender. So we work with specifically lenders that specialize in the short-term rental industry that, like Matt touched on, they're able to use a projection as far as the Air DNA, and they usually use an 80% projection of that number, and that's where that income comes in to qualify you for that DSCR portion.
Yeah, exactly. And that's kind of what we hear too, right? Is our clients, and especially when they come to this point, if they've hit that wall, that's the sad part, right? Is they do feel kind of beat down. And what we hear from them all the time is that kind of feedback. They're not bad borrowers though. The deal isn't a bad deal. The loan type is just wrong. And that's why this whole product DSCR exists. So kind of looking through, I guess, just an explanation really of what is in full, like that DSCR loan, kind of up top. What does it stand for? What does the ratio look like? How does it get calculated? What does that look like for our clients?
Yeah, so the DSCR ratio is basically the debt service coverage ratio. So that's a fancy way of saying basically the way the income comes in with your monthly payments. So how that's broken up is the income that's used, like that we're able to use, is usually a projection as far as Air DNA. Like some of the lenders will use a little more of an in-house projection also on top of that, but that's usually where their income comes in, and they usually use 80% of that number. So when you're actually on AirDNA, if like say you're searching in the Florida market and you've got a property you put in there, you put 4 bedroom, 4 bath, and then usually how you would do that in AirDNA is you would put 2 guests per bedroom, and then that's the number that would come up. So then they're going to use 80% of that to account for the operating expenses usually. And then that's the income number that would be used per month, basically.
Okay.
So then that's going to line up against your PITIA, so your principal, interest, taxes, insurance association dues, basically your monthly payment. And you divide the income by the monthly payment, and that's where you get your DSCR ratio. So to qualify, that number needs to be 1.0 plus. And depending on which lender we go with, sometimes there's actually an advantage for that even being even higher as far as like your interest rate is concerned, but at least needs to be a 1.0 plus, and basically that means the property is cash flowing.
Yeah. Okay. Yeah, that makes complete sense. Obviously, they're going to make sure it's going to be making the money to pay those bills.
Right.
Obviously, perfect.
Yeah,
So
just to that,
go ahead.
Ryan, real quick
Yeah.
too, is we have obviously with this being all that we do, we have access to lenders that will go below that 1.0 DSCR ratio, which is great news. Now, the rate and terms may be a bit different, but what we've seen investors do is say, hey, I know this property is a winner even though the rate and terms right now aren't exactly what I'm looking for, what they'll do is still close on the property. We can get to a lender that can go under the 1.0 DSCR ratio. They'll prove that income over 12 or 24 months, and then we can refinance the property into better terms once we show, hey, this property is doing $150,000. Our DSCR ratio is 2 or 3 now because we knew it would perform. It's going to be a super property. So
Yeah.
they'll make sure they secure the property up front with maybe not the best terms at that time, but then we'll refinance in the future when we can prove that's a high performing property. So that's a thing that we see often with investors.
Yeah, and that makes a lot of sense, especially for those properties that might be in a more risky kind of area. We
Exactly.
know that the data is there. We have some sort of comp structure that we're looking at, but ultimately the actual Air DNA data is not really leveling out. So that makes a
Exactly.
lot of sense. Having that higher likely rate up front for that initial investment, but then that refinance is gonna will recalculate you once you have that 12 months of revenue. That makes a lot of sense.
Exactly.
Awesome. So Rand, specifically, how does other than Air DNA, is that the only way that our lenders are actually determining what the rental income is? Because with
So
STRs, obviously, you don't always have a lease. So how does that work exactly?
Yeah, so that's going to be on a purchase. Usually on a purchase is when, because basically you're not going to have previous financials from you as the owner. So that's how they use that for a projection of what the property would make. If you're doing like a cash out refi or a rate and term refi, which is also an option with us, we're not only purchase loans, they're able to use previous financials. So we would just get the previous financials from you, submit them to the lender, and they can usually use around 100% of those.
Awesome. That's incredible. That works
And
great.
also, too, Ryan, I probably didn't touch on, some people might not have experience with what AirDNA is. So basically, if just a high level of what AirDNA is, it pulls comps in from what the properties around are making, similar to almost like a MLS or something. Like it's pulling comps, and they're using the data that it's making from Airbnb, Verbo, the different platforms, and it's able to give an average of what that property would make.
Yeah, exactly. Awesome. So yeah, that Air DNA, I know that here on kind of the sales side, we use that on a daily basis when we're talking about like revenue projections and assumptions on properties we're targeting. So that makes a lot of sense. So that would also come through when we're doing on the lending side as well. Speak to me, curveball, real quick. Speak to me about House Canary. I've actually just recently seen this come up on quite a few conversations. So this seems to be like a lending tool they're using to underwrite or at least quote on some properties. How does House Canary work for that underwriting process? Do you have any insight on that?
Matt, do you have any insight on House Canary?
The
This
AI
is
tool that's being used for underwriting. I was asking because I had seen something come up on that recently, and so I did see
that.
some of the a lender using that for DSCR.
Yeah, that would be a new one to us. I haven't heard of that. Like I said, the primary is going to be the AirDNA used. But
Okay,
yeah, we're
perfect.
definitely looking into that.
All right.
See
Anytime I
what.
see a new name pop up, I always got to make
Yeah.
sure I'm not going crazy here. So thanks for that feedback. That just makes me know that someone's using something that's not a common tool. So I appreciate that. So the minimum that the DSCR lenders will accept, we talked about that being really generally speaking a 1.0
Mhm.
for the actual break even. So with that, we talked about what happens when the deal comes under that threshold, obviously. And then we also have, when it comes to using those kind of underwriting tools like AirDNA, have you seen any sort of issues when it comes to potentially, just like I said, newer sub markets, those kind of the underwriting, it might not be there. Are you having to expand the kind of net that you're looking for those comps? How does that work when we don't have a lot of available options to choose from?
Yeah, I can speak to that real quick, Rand. I mean, one of the huge benefits of working with STR specific agents is they're going to provide you a property that will succeed, and they're going to base that off of comps they've seen, right? I mean, every savvy agent is going to have comps of properties that are performing at a high level, which is why they're sending you said property. The great part about working with a niche lender like us is we can use those comps to argue with underwriters, right? Like say, hey, AirDNA is only showing 50 or 60, and we can show them two or three or four comps that are doing 80, 90, 100. They have the ability to use those comps to readjust our income and our DSCR ratio. So again, if you're not working with a specific lender that does this, they're not going to know to do that, right? They're going to just look at the
Mhm.
number or just hear from the underwriter and say, hey, sorry, it doesn't work. Whereas when you specialize in this, it allows us to kind of provide those comps, work with underwriters, work with lenders, talk through it. We're talking to human beings that are underwriting the properties, not
Yeah.
just AI, so we can prove, say, hey, we've got two or three comps that are doing much better. This property fits into those comps for XYZ reasons. Can we recalculate that income to try to get that DSCR ratio where we need it to be? Again, we can do it under the one. It's just we want to try to get over that for the best terms possible. So if we've got the
Yeah.
ability to argue with some comps and get us back over 1.0 and get much more favorable terms, that's something that we're able to do.
Awesome. Thank you so much for that note.
Mhm.
Specifically about property types that work for this type of loan, is it just single family cabins or does it go broader than that?
Yeah, so like as far as property types, the most of the types of properties you're going to be looking at for short-term rental are going to be qualified for this type of loan. Like if it's a beach property, mountain property, condo, there are some specific instances with condos where they can be not qualified, but Where we get into a challenge is like the unique properties. If you
Hmm.
have a A-frame in like a urban market, for instance, it's something that
Yeah.
like doesn't fit the market. That's where that can be a challenge. So as far as like single family stuff, vacation rental markets, especially if you're in like a typical vacation rental market, you're
Yeah.
usually going to be okay there. It's when you get into those unique like dome structures or A-frame is fine as long as it fits the area.
Yeah.
But yeah, when you get into like where they don't specifically fit that area, that can be a challenge.
Yeah. Like a yurt in a downtown area is not going to really
Yeah.
qualify that. Yeah. Got it.
Right.
Understood.
Right.
Yeah.
Yeah, Ryan,
That makes a lot of sense.
we can
So,
also run into problems when the property is either zoned commercial or has commercial equipment in it. I just ran into this one in the last couple of weeks where the property is basically a giant Airbnb. It's like 11 bedrooms, 9 bathrooms. The thing is sweet, but it's zoned commercial and has a commercial kitchen. And so we've run into DSCR issues because it's zoned commercial compared to residential. And so that can be another thing that is something to look out for. Now, what we're doing on that property, again, why you want to work with the correct lender, is we are getting the zoning changed to residential and removing the commercial kitchen, refrigerator, stove, things like that, to remove the commercial kitchen and
yeah.
change the zoning from commercial to residential so that we can qualify for DSCR. So again, one of those things that you would, if you're not in this niche and in this market, you'd never know to look into something like that.
Yeah.
It's going to be a little bit of a process here to make that happen, but something else to look out for sure when you're looking at these financing.
Yeah, so obviously multi-unit is totally fine too in that what we were just talking about there. So single family is fine as well. Let's talk briefly, just a little tidbit. How about condos? How does that flesh out with DSCR loans?
Yeah, so condos, the main thing is where it gets a challenge is if it's designated a condo hotel like, or
Mhm.
condo tel. So if it
Yeah,
has like a check-in desk and it's like part hotel, it's treated like a hotel, that's where they kind of fall outside the range of what our lenders can usually do. As
got it.
far as a condo in a, beach market, stuff like that, we do plenty of those and yeah, that wouldn't be an issue.
Awesome. Okay. So I mean, pretty much anything they could realistically, I mean, within logic buy. I mean, it can be covered by DSCR. Like just like
Mhm.
you mentioned, zoning has it matters. Specific, aesthetics do matter ultimately, especially when you're looking at like the market that it's in. So that makes a lot of sense. Um, I really want to walk through kind of what that this like introduction looks like. What's that first call sound like for you and the clients when you are kind of walking them through DSCR, and what does that look like? That first interaction and kind of what you ask for to get them moving in the right direction. What does that look like for you guys?
Yeah, the first thing is going to be like kind of the intention for a property. So just to speak to DSCR specific, these are business purpose loans intended for rental properties. So if
Mhm.
you're treating this property like a business and non-owner occupied, that's where it falls into the DSCR range. So as far as like getting quote, like we're going to work with you, have you narrow down properties, have you, because usually we kind of start working with people before they've narrowed down. So we kind of start at a high level just to see, what type of market you're in. If we have if the DSCR loans we do, if they fit that market and we don't see that being an issue, and we'll kind of talk through, what kind of properties you're looking at. We'll get just, a general idea is of like what you're looking for and kind of talk through the program. And then really where we come in is when you have a property that you want to like for us to take a look at, we can actually get you some quotes that'll give you an idea of interest rate, cash to closing, payment amount, and stuff like that. That'll be able to give you a good idea for your underwriting process as you're looking at new properties to kind of give you an idea of what that loan would look like.
Awesome. And speaking to the rates actually that you had just mentioned, when we're looking at conventional up against DSCR, what's the kind of parity there? What do the rates look like in comparison to like traditional lending?
Yeah, I think that's a common myth almost, is that conventional rates are substantially better than DSCR. That's not the case. When you're looking at second home loan rates or investment rates on conventional Fannie, Freddie, or whatever it may be, those typical agency loans, the rates are very similar to DSCR, if not better on DSCR, just depending on what kind of prepayment penalty and terms that we're looking at. So
Mhm.
that's one of those huge myths that I just feel like everyone's like, oh, I got to get conventional so I can get a better rate. years ago they changed where second home late rates and investment rates used to mirror primary residence rates a lot closer. Years ago that changed, and now those secondary rates and investment rates are much higher than primary rates. So they're very much in line with any sort of DSCR rate that we can get. Again, a lot of the times we can get better on DSCR just depending on what prepayment penalty and things that we're looking at. But I'm glad you asked that question, because so many times you have people that want to go conventional and they're like, I just want to do it because the rate's going to be better. And that's just not the case.
Yeah, that's it's a good point too because I have been part of those conversations before too, where clients have said, "No, I already know the answer to that," and it's let's talk. Let's just talk about it first and see what that's going to look like for you. Because 9 times out of 10, I've seen that come on the better side for our clients using DSCR product. So thank you so much for that.
Yeah, and let us
Um,
run through it, right? Rand and I can always
yeah,
just compare the two of them. Let's talk through it. I mean, you've obviously got a big benefit with just down payment on conventional. You can do a 10% down second home loan, vacation loan, and that's kind of why a lot of investors are going to lean that. But that's something Rand and I can certainly help with. Let's run through the two scenarios and see what makes sense.
awesome, absolutely. Hey, I am going to bring this up because we had a question just pop up, and this is kind of in line with where I was going to ask next, but midterm rentals, how does that pencil? What's the I know it's kind of obviously like kind of middle in between. You have a midterm product, so not long-term leases, and then of course kind of more designed to a short-term space. What does that look like as far as DSCR? Do those qualify?
Yeah, midterm rentals is kind of one of those that's right in the middle. So
Yeah.
depending on which lender we go with, they will maybe evaluate it a little differently. Some will
Mhm.
treat it more like a short-term rental, like if it's below 90 days, the average is below 90 days, they'll treat it more like a short-term rental. And then some will treat it more like a long-term rental, which we can definitely do long-term rental properties also. So just depending on, how the lender would evaluate it. But the answer is yes, we can do midterm rentals. It just depends on the lender, how they're evaluated.
Okay, perfect. Thank you so much for that. I appreciate that. So the the obviously we talked about the DSCR property income base. We all talked about the property types and kind of how that works and what that like intro call would look like and what you guys would be looking for in that regard. So I kind of want to look a little bit on the borrower side, and I know that we're getting a little bit ahead of time here, but we're just being very efficient. So I want to shift to the borrower side. So Matt, what does a lender actually want to see from the person applying? Obviously, starting with credit, what would that look like? What's the typical client look like for a DSCR loan?
Yeah, typically, I mean, most lenders are going to be a minimum of 680 on the credit score, right?
Okay.
If we want the best terms, however, 720 and above is going to get you in the range for the best terms, best rates, and things like that. We can go down to 680. It's totally doable. It just kind of can impact that rate a decent amount. So really, we want to be 720 and above if at all possible. But 680 is your minimum to answer your question. Um, the other thing we like to say, standard down payment on DSCR is going to be 20 to 25%.
Yeah.
Depending on what that DSCR ratio comes back at, that can kind of impact what the down payment is going to look like. Most of our lenders are totally fine going to 20%, as long as that DSCR ratio typically is over 1.0. Where it gets below that, you may need to look at 25% down. We do have the ability for 15% down. We don't like to shout that from the mountaintops just because it can be hard to qualify for that. Or even if we do, the rate and terms may not be what an investor is expecting. So let's look at it, right? Let's run the numbers and see what makes sense. But the standard minimum is going to be your 20 to 25% down, and you're really targeting a 720 or higher credit score, and 760 and above is going to get you into that tier one where we've got the best rate and terms possible.
Okay, awesome. So 760 is like that golden number to get the best rates that we have out there. That's
It
awesome
is
to know.
760 and above is the number we're targeting for sure.
Yeah. Okay. And obviously, you just mentioned that there are programs that exist below the 20%, but that might be more of an uncommon. Usually higher rates. I'm assuming, and going to be at that point too. So it might just make more sense to go with that 20 or 25%.
Exactly.
Um, yeah. So obviously, this is kind of goes a little bit in line with how traditional lending works, but really about the down payment. How does that affect that DSCR loan? Obviously, in traditional, it's larger down payment equals lower payment and better ratio. Is that kind of the same process we look for with DSCR as well?
Yeah, you are usually gonna get a little rate break from putting a
Yeah.
little more down, like, for
Mhm.
the instance from, like, 75 LTV to 70 LTV, you're usually gonna get a little rate break on that up to a certain point. So, well, yeah, that's what we're here for, to run those options for you, to run, that's what we wanna do with you, is be able to run, "Hey, this is what it looks like at 80 LTV. This is what it looks like at 75. This is what it looks like with this prepayment penalty. This is what it looks like with a 30-year fix," and be able to run all those options with you so you kinda have that as your underwriting process as you're going through and looking at properties.
Awesome. Thank you for that.
Yeah, it's really just a
So
break even at that point, Ryan, right? It's like, hey, 25% down is going to save you a quarter on the rate, which is going to save you 50 bucks on your payment. What's our break even for that extra 5% down? Is it 5 years, 7 years, 10 years? Then maybe it isn't worth it. Or are we able to get the rate low enough that it breaks you even in 2 or 3 years, which is kind of a magic number for a lot of investors for it to make sense. So that's what Rand and I are here for, right? Let's look at all of those scenarios. Let's run the break evens. Let's see what makes sense. Do we want that extra 20 to $30,000 extra 5% in our pocket to do renovations, to do upgraded furniture, design to make sure you're in that super property category to perform the best? Or do we
yeah,
want a little bit lower of a rate? Like there's just so many different ways to play it. But a lot of the times our investors want to keep that money in their pocket. And so even the rate break may not be worth it, but that's what we're here to do. Let's run those numbers and see what makes sense.
yeah, absolutely. I appreciate you sharing that too. I mean, there's the regarding the call and kind of really what the client should be prepared to kind of present to you guys. Obviously, for you to get the best picture, the quickest response and quickest picture, they should probably come to the call with a couple things ready. So what would that look like? What do you need for them to have on hand to help kind of navigate as fast as possible into that kind of that quoting piece?
Yeah, what I would say, honestly, you mentioned having a lot prepared. I want to speak with you when you're thinking about a short-term rental when you're thinking about a short-term rental purchase or a refi, and you just want to know, like, what type of loan fits you. You're just starting to look at markets, things like that. We want to be able to help throughout the process. So as far as having a lot of things prepared, it really is just that you're looking to do short-term rental investing. We can even do long-term rentals also. So yeah, you're an investor looking to do that, or looking to refi, and we'd like to start from there and kind of walk you through the process. That way we can be the most helpful.
Yeah, awesome. So one of the questions that we do get a lot, and this is mainly from kind of our first time short-term rental investors and some of those who don't have a lot of experience with rentals and STRs. Um, so for those first time short-term rentals, they might not think they can qualify for a DSCR loan, someone who's never operated. So speak to me about that. Is there any kind of historical data you need as far as performance to really justify that for a first time investor?
Usually for a first-time investor, they would just need on their credit report, when the lender runs the credit report, they would need to show 12 months of mortgage history within the past 3 years. Different lenders, it kind of depends. Sometimes it's just they've owned a property at all that they can show proof for.
Okay.
But yes, we're able to work with like first-time investment properties that are outside of just your primary.
Okay. Perfect. Okay. And then obviously we know as far as income projection is concerned, income projection, obviously there's historical data, but there's also really there's market data as well. So that's, if I'm correct, that's kind of what they're basing it off of anyways. It's really not you as the individual. It's really the market and what the market is speaking to as far as that revenue is concerned. Is that accurate?
Absolutely.
Awesome.
Yep. That's what AirDNA is. It's going to use projections for that market. And then I really wanted to touch on something real quick, Ryan, that what does a buyer have to bring and have prepared?
Yeah.
That's the greatest thing about a DSCR loan is it's very, very simple. The process is very streamlined. So it's not like you're coming to the table with us and saying, hey, gather 30 days pay stubs, gather your last 2 years W-2s, gather your last 2 years tax returns, get all your mortgage statements, get all these documents and submit them to us. That's the best part about DSCR, right? It is using the property itself to qualify. It has nothing to do with your personal information. I mean, your credit score, yes, but
Yeah.
your actual personal income. So you don't need to come to us, like Rand said, we want to just help you out from the beginning of the process. You don't need to come with us with 50 documents, for us to see if it's going to work or not. Typically, we just need to know roughly where your credit score is so that we can get you an accurate quote.
Mhm.
And then if you have a property address in mind, Rand and I can kind of run through our projection of numbers. You've got your savvy agent that can run through their projection of numbers. And that's really all we need to get you a good quote and get a good idea of what that property is going to look like. Because as long as we have that information up front, we can kind of see where our DSCR ratio is going to land, which is going to allow us to kind of hone in those terms from the get-go so that before you even put in an offer, you're very confident of exactly what your debt service is going to look like and exactly what your terms are going to look like. Because we don't want to do is say, hey, yeah, we can do 6.5% rate with this property. It's great. And we didn't run any numbers. And then we actually go through the process and the rate's 8%. And now your cash flow is completely different than what you were expecting. So like Rand said, it come to us as early as possible. But there isn't a ton of documents that you need to come to
Yeah.
us with. Just let us know where your credit score is and what the property is, and we'll kind of go from there.
Awesome. So, really, regarding one more thing, kind of about the process and really qualifications are concerned, what about for those investors who are wanting to purchase the property, of course, under an LLC? Is there any shift in how that conversation might migrate? Is there a little bit different, I guess, nuance to that conversation?
Yeah, so these are business purpose loans
Okay.
intended for rental properties. So yeah, as far as closing an LLC or corporation, usually not an issue at all. And there's usually not even really a whole lot of extra steps for that as far as the lender getting the documents. But yeah, they can be closed in an LLC.
Awesome.
Yeah, huge
Incredible work.
advantage compared to conventional there too is just in conventional you're not able to close an LLC on a DSCR loan. You can close an LLC right at closing. So conventional, what you have to do is a quick claim deed after closing, which is just another expense and can kind of open up to some risk there. Whereas DSCR, we establish an LLC and close in it right at closing and makes the process that much smoother.
Awesome. Incredible. Thanks so much for that information, guys. I really do. I do still we do have some questions that are coming in the chat. I know that we've really kind of moved through rather quickly some of our key topics, but we've really been efficient with that data. I really appreciate you guys having those answers just like ready and prepared. I would love to jump into some of the questions that we have because I can see some more rolling in right now.
Hmm.
So let's go ahead
Yeah.
and pop into the chat and look at some questions we have.
Yeah, I saw one come up with Carissa right here. How do you handle a property that's currently vacant or mid renovation? So those are going to be two different scenarios. So
Mhm.
vacant, if the property, it says, can you use the projected revenue if it's not an active short-term rental? Yes. So if it's vacant but rent ready, so it doesn't have to be short-term rental ready. It just needs to be rent ready, almost as if like like that there's no the electricity's running, the water's working, the property's ready to, and available. It's not in renovation condition. The renovation, that's where it falls outside of the DSCR loan. If you're doing some paint upgrades and stuff like that, it can still be considered rent ready. But if it's mid renovation, these are for rent ready properties, so it would fall outside of the scope of the DSCR loan.
That's a very good point. Carissa, thank you for asking that question too, because that is not something that I would have thought of, to be honest with you. So
Yeah, that is a
fantastic.
good
Thanks for
question.
that. Yeah, Stephanie, I'm gonna pop in real quick. Yes, this will be recorded, so you'll be able to kind of reference this in the future. I do see that you had missed the very beginning of the actual call. I do see that we have, of course, we were going to get this one, Brandon, in the chat. What are the approximate current rates we're looking for 20% down with a higher credit score? Maybe that 760 we were talking about earlier.
Yeah, I just quoted a few of those yesterday. Depending on the big difference there is going to just be depending on what prepayment penalty we want. But a standard 3 or 5 year prepayment penalty, you're anywhere from like mid upper sixes to low sevens. Again, just depending on what prepayment penalty we want. So I quoted a couple yesterday from 675 all the way to 7.375, just depending on what prepayment penalty and terms they wanted. So it can range there, but it's right in line, like I said earlier, with conventional loans. And it's nothing. A lot of people think that DSCR rates are brutal, and they're really good rates. So anywhere from mid to upper sixes to low sevens is the range that we like to give.
Awesome. Thank you so much for that. I know that was going to be a question that came up too, so that's fantastic. We got that answer out there. So I'm looking here, and I really don't believe we have any more pressing questions. Anybody else have anything for the group? Look here, Stefan. Yes. We answered, yeah, it looks like midterm rental. We answered that question a little bit earlier in the chat. Well, gents, I know that we're, like I said, ahead on time, but if we have no other questions, and as we mentioned, this is going to be recorded, let's go ahead and land the plane, guys. So, really, for those on here who are watching, the kind of call to action here is, one, I would go ahead and pull that air DNA report on whatever property is you're looking at. So, take a look at what's around the neighborhood, what those are performing, and it's going to really help educate you on what that number is going to look like for your property as well, given no massive variances. And then obviously a call to Matt and Rand. They're going to be the ones, even if you're 6 months out, they're going to be the ones to really help guide you through that conversation and that process. And that way, when you are ready for that purchase, that conversation's done. It's ready to go, and you're not having to have any of those difficult, really conversations to navigate there towards the end. But guys, how do people reach you directly? Matt, I'll go ahead and start with you. Really, what's that contact info? How they find you?
Yeah. So you can reach me at 864-400-0788 is my phone number. I'm sure we can get out email address as well. I can post it either on Facebook, Ryan, or wherever we need to. I've got a Calendly link we can get out there for just scheduling a call, which is what a lot of people do. We can just kind of get on and start that preliminary conversation, so we can get all of that contact data out. And like everybody's mentioned, we want to start with you guys as early in the process as possible and let us help you and walk through it so that you're really confident going into the purchase and aren't wondering if or what financing will look like.
Yeah, awesome. Thank you so much. And Rand, kind of same to you as well. How do they find you?
Yeah, so my direct line here is 737-265-6128. And I think if you forget that or anything like that, I think both of our info is there on the website too. So
Mhm.
as far as like Matt was saying too, like we want to talk early in the process with you. So like you said, 6 months out is a great time to start talking to us, because what's going to happen, you're going to have initial phone call. We're going to cover a lot of it. You're going to forget things along the way. You're going to have 5 questions as soon as we get off the phone, and we want you to be able to call us and touch base as you're going through the process to be able to kind of jog your memory of things that we're able to do anyway.
Yeah, awesome. I am going to kind of barge in here real quick. Brandon dropped one more good question in the chat for us, so we can just address this real quick. Can you speak to some of the prepayment penalties? They're not very familiar with that, and just if you could give some clarity on what that looks like.
Yeah, so just to walk you through, different lenders can call them different things, but there can be options anywhere from like a zero prepay, a no prepay, which is going to usually be a quite a bit higher interest rate, all the way to what some lenders call a 5-year fixed prepay, which basically means any time that the loan would be paid off up until the fifth anniversary date of the loan, it'd be subject to a 5% prepay. And then there's options kind of all in between. There's step down prepays, which work down like 5, 4, 3, 2, 1. So they reduce 1% each year. Or there's a 3-2-1, which reduces 1. So 3-2-1 reduces 1% each year. So that's what we want to be able to do, walk you through all those options, because there are a lot of factors that go into DSCR rates. So we want to be able to walk you through the options and give you comparisons where you can kind of decide which one's the best fit for you.
Awesome. Thank you so much for popping that in there for us. Brandon, thank you so much for the questions. So we guys, just to wrap up, obviously we do these lives on a regular basis. So if you're not following the page, please follow the page so you don't miss the next one. We cover market data, financing, deal analysis, really anything that's going on with short-term rental spaces. But Matt and Rand, thank you both so much for joining today. It's exactly what I wanted our clients to really hear and kind of get a taste of this morning. So I'm very grateful for both of you for attending today. Thank you so much.
Yeah, thanks for having us.
Absolutely. And one last plug for the website. You go to mystrhomeloan.com, by the way, and you can get Rand and I's information on there. You can kind of get an idea of our products and things like that, and everywhere we're licensed and all that. So that's one more place to find us.
Awesome. Perfect. Thank you so much for that. And to everyone watching, let's go find your deal. You know now how to finance it. So we'll see you. We'll see you when it's time to make that purchase or start talking. So this is obviously Ryan from Savvy. I appreciate you all, and everyone have a great day. Thanks so much.
Thanks, guys. Take care.
Bye bye.